Good day, everybody. My name is Conrad Kluge, Senior Wealth Advisor and Senior Portfolio Manager with the Kluge Wealth Advisory Group at Wellington Altus Private Wealth. Welcome to the October Client Monthly Update video. In this video, we're going to touch on 5 segments. We're going to have a team update. We're going to introduce a new segment called Opposite View, where we try to take a look at the issues of the day from a different lens. We're going to have a monthly market update, a monthly portfolio update, and last but not least, answering your frequently asked questions. In addition, I'd like to note that we've had a couple of really great webinars recently, one on estate planning with the good folks from Seidel, and in addition, a market and economic update with our very own Dr. James Thorne. So please look for those on our YouTube and X channels. Now, let's get into this month's video. So let's jump into a quick team update. So before we get into some specifics, I just want to take a moment to thank each and every client, especially those ones that have taken the time to refer somebody or have consolidated their wealth management business with us. We really appreciate your trust and confidence, and we're here to get the job done for you. Now, in terms of the team here, we're in the process of looking to add and continuing to add more strategic depth and more advisory depth to our team. And to that end, Scarlett Jones has stepped up and is beginning to learn the ropes on financial planning. Jordan is beginning to learn how to become an investment advisor associate and is beginning to take over some relationships, specifically with the kids of existing clients. And Kyle is a full investment advisor and is beginning to learn the investment decision-making process more formally. That always brought up a few questions from some clients. Where's the next hire? Well, I'd say the vision on the next hire is we are looking for somebody that's going to take over some more of the administrative role from Jordan and Scarlett, so they're able to spend more time focused either on financial planning or, in Jordan's case, learning how to become an advisor associate. Now, turning to a market update, let's discuss what happened over the course of the month of October in terms of equity markets, fixed income markets, and commodity markets. In equity markets, we saw a sharp sell-off in the beginning of the month, followed by a powerful recovery that led indexes to new highs. And the pattern that we'd seen early in the year, which was growth stocks outperforming value stocks, reasserted itself after a break that started from July through the end of mid-September. In terms of fixed income, we did see bond yields increase this month, which is a bit different from the past, where yields had been dropping. However, they're still well contained at this point. We don't believe that it's part of a new trend. In terms of commodities, we generally saw commodities prices drop, with the exception of Bitcoin, which did rally significantly. But due to falling oil prices and other commodity prices, we did see the general level of commodity prices, as measured by the Bloomberg Commodity Index, drop over the course of the month. And it's also important to note that from a stock perspective, October was really good. I know October has a bad reputation in people's minds because of past events and associations with Black Monday in 1929, as well as the 1987 crash. However, October this year was great. And although it's unusual for the stock market to be up in October statistically, it's a pattern break that I'm happily embracing. Moving on from a market update, let's talk about what happened in portfolios this month. October was a really great month for portfolios, with strong positive performance overall. Now, that's a bit of a break from the usual pattern that many clients expect, with October typically being down. But as I mentioned in the earlier segment, that's a pattern break that we're willing to take. In terms of portfolio activity, we did make a number of changes. The first, on the US dollar portfolio, was to use cash to buy shares of a company called Eaton Corporation, which is an industrial conglomerate that operates in several high-growth industries inside of the United States and worldwide. In terms of the Canadian dollar portfolio, we eliminated a couple of names, TFI Group, as well as the iShares Energy ETF, XEG, and replaced those with positions in Tesla, GE Aerospace, and ServiceNow. If you have any questions about why we put any of these positions in or took anything out, please give me a call. Happy to have an in-depth discussion on it. For October, I wanted to introduce a new segment. We're going to call this one Opposite View, where we take a view or a question that I see in the marketplace or from clients, and I turn the premise on its head, and we look at things from the opposite lens. Now, I think this is important because you always want to look at all issues from multiple angles so you can get as close to the truth as you can. So there's been a lot of questions, and there was even some fairly famous investment banks that published some pretty negative research pieces here over the course of the month. So what I wanted to do, as opposed to focusing on the downside risks, what I wanted to talk about were the potential upside risks that are out there. This is important to recognize because despite all of the worries that are out there, most of the time the stock market goes up. So what could possibly drive that? Well, let's talk about one major driver, and that is AI spend. Now, based on some work from Dan Ives at Wedbush Securities, he estimates that for every $1 spent on graphics processing units, or GPUs, those are the big chips made by NVIDIA, AMD, and others that power AI, you see $10 of downstream spending from that. And now that may not seem impressive on the surface until you realize that there's approximately $1 trillion, $1 trillion of capital expenditure needed in order to renovate existing data centers in the United States, let alone build new ones. And based on the spend to date, we're only about 15% way through the process. So if we see continued high AI spending or accelerating AI spending as companies begin to realize the benefits of it, which we're starting to see even now this earnings season, then this could provide a significant economic tailwind that no one's counting on. And it would be very, very significant, just given the size of the spend that's available. In addition, the productivity gain that you'd see accrete to the US economy would also help drive the economy forward, which could overwhelm the headwinds that we're facing just because we have a more powerful tailwind. So we don't want to be immune to the downside risks or ignore them, but we also want to look at risk as well in terms of what can go right and what are the upside risks that perhaps investors aren't fully appreciating and how they could be surprised to the upside. And we are back. As you can see from my suit, we're filming this on a different day. I want to make sure we're addressing frequently asked questions as close to month end as possible, just given the impending US election on Tuesday, November 5th. So one of the most frequently asked questions we saw over the course of the month was around the impact of the US election on investment portfolios, markets, in more general terms. So in terms of markets, what I wanted to focus on is the fact that there's a very supportive backdrop irrespective of who wins. And really, I want to also emphasize that nothing I'm saying here is a political opinion or is looking to endorse one candidate or another. We just want to talk about the facts and where things are at. So, the bottom line is that irrespective of who wins the White House in November, there is a very supportive backdrop for equities. It's very clear at this point the US economy is growing, interest rates are falling, and inflation is falling. And that has always been a positive combination. And quite frankly, when you start to add in the Chinese stimulus, which is adding liquidity into the system as well, this has generally been very, very positive for equities when you look at historical patterns. Now, that doesn't mean that there can't be volatility, and we do see, of course, some folks are fearing that the election results will be delayed, and that type of uncertainty can create some short-term market volatility for sure. But I think that would just be an interruption in what is ultimately a longer-term up pattern. In terms of what the markets are saying, we can see very clearly that polls are very, very tight, and that the betting markets are indicating towards a Trump victory, although those odds are far from certain. The market itself is actually starting to price in, as you can see in the price action of Bitcoin and US regional banks, the potential for a Trump victory. But again, it's nothing very definitive. I think really at this point, we have to wait for the actual result to come in. And I think irrespective of the actual result, what we have to do is, again, look at that big picture. When you have falling inflation, falling rates, and a growing economy, that's always been good for stocks. Moving on from questions around the US election, let's tackle the next most frequently asked question that we encountered in our client conversations, which revolved around what's exactly happening here this fall. I was expecting things to be worse. So yes, usually, and in terms of seasonal patterns, September and October are negative. And this is, of course, documented very in minute detail in the Stock Trader's Almanac, which is a great source for this type of seasonal information. However, I think in this situation with this year, there's so much perception of uncertainty around the US election, and the fact is that everybody, air quotes, knows that September and October can be bad, that although we did see some volatility events, at the end of the day, these events resolved higher simply for the fact that everyone was already aware that they could exist and had a position for them beforehand. A lens that I like to put on the markets at all times, whether that things are up, down, or sideways, is an analogy that I like to call the discomfort machine. And we always want to remember that the stock market is a machine that wants to create the most discomfort in the most number of people. So if investors are positioned for markets to be negative and that they are pessimistic, then the markets will resolve higher because that makes many people uncomfortable. On the other hand, if investors are too optimistic, then of course the markets will resolve lower because that in turn makes more people uncomfortable. So we just want to keep that in mind as we're thinking about things, and that, obviously we've had a great couple of months and it's unusual to get them, but let's take them. The final question that came up a few times over the course of the month, and I think this was driven by some articles that I did notice in financial media, was around whether markets are air quotes expensive. So to answer that question is a yes. If you look back through time and you look at the average valuation of the S&P 500, for instance, against its average earnings multiple over the last 30, 40, or 50 years, then yes, today's market valuations appear to be expensive. That's a fact. However, facts have to appear in context. I think it's very important to understand the context about how this works. Index construction is not static. The stocks are the biggest index weights in today's indexes were not the same stocks that were the biggest weights 20 or 30 years ago. And also, it's important to note that the stocks that are the biggest index weights today, which is largely US large cap technology, are growing their earnings at a rate that is much, much higher than the stocks that dominated indexes in decades past. So it's natural, of course, if you have a higher rate of earnings growth, that the multiple would be higher on these stocks. So really a statement like that might be true in fact, but really what you're talking about is you're comparing apples to oranges. And I'm going to emphasize how important this is, especially when you start to take a look at higher earnings growth stocks, typically in the technology sector. Because if you look back to May of 2021, you can see that the S&P 500 was actually trading at 33 times earnings, which is substantially higher than we are today. Now, if we go forward in time, we see that we're about 26 times earnings. However, in the meantime, the stock market did not go down when the earnings multiple compressed from 33 to 19. It actually went up 38%. And that's because earnings growth was actually faster, and so it allowed the market to rise despite the fact that the multiples compressed. So a story like this is interesting, it's eye-catching. I mean, it is based in fact, so we want to give it the devil is due in that case. But I think you have to always take a look at the broader context when you're looking at factoids like that, because you have to understand the full story to make sure that you're not jumping to a conclusion that might not otherwise be warranted. So in wrapping up here for the month of October, we brought you a team update, we talked about portfolios, we gave you a market update, we touched on your frequently asked questions, and we introduced a new segment called Opposite View. I'd also like to take another moment to remind you of our existing webinars that exist on our YouTube and X channels. They will be there for you to look at your convenience. And of course, if you have any questions or is anything you want to discuss with myself or the team, please reach out. Contact us. We are here to help. Thank you and enjoy the rest of your day.